Ever wondered what a finance professional invests in? Today, I'm going to be showing you exactly what I invest in and why. I'm Jeff, a qualified chartered accountant with over a decade of experience, and I have a passion for personal finance. My aim is to show people that numbers and money aren't scary, and I can show you how to set good financial behaviors to set you up for a lifetime of making your money work for you. And if you want to learn more about personal finance in a fun and easy to understand format, please subscribe and like this video as it would really help me out. I owe you one. Now let's jump right in. But before we get into it, it's important for me to state that this video is for entertainment purposes and does not constitute individual financial advice. I have no idea what financial situation you're in, so it's impossible for me to make any recommendations on what you should be doing with your finances. And you certainly shouldn't be watching a random guy on YouTube and copying everything he does when it comes to finances. Always do your own research and if necessary, consult a qualified financial professional before making any financial decisions. So when should you be investing? Investing should be a long-term activity. At the very, very least, you should be holding your investments for at least 10 years. Investments can go up as well as down, so there's a very small possibility that you could lose all of your money. Therefore, you should only be investing money that you can afford to lose. That's why it's so important that you have a separate savings pot held in cash for your emergency savings, typically 3 to 6 months worth of your monthly outgoings. If you're trying to save up for a specific purpose, for example, a deposit for a property, you should definitely not be putting these savings into investments. This is because if markets were to dip just before you needed the money, you'll be placed in a very difficult position. With investing, you have to get into the mindset that if you were to lose everything, yes, it's going to be very frustrating, but you still have your cash savings to use, so you're not going to be left out in the streets homeless. When I was coming up with my investment strategy, I firstly had to ask myself why I wanted to invest, as this would help me determine what sort of stocks I should invest in. I wanted to invest in order to help me gain financial freedom and hopefully help me retire early. This would take many decades, so I would not be concerned with short-term trends, and I would definitely not be believing any of the get-rich schemes out there. Therefore, I would need a fairly risk-averse strategy, which matches my personality anyway. My strategy was to grow my portfolio over many decades, whilst also be able to benefit from dividends that was either reinvested or paid out as and when I retired. This is why this video is not financial advice, as my strategy will not suit everyone, and everyone will be in a different financial position. We will all have different attitudes to risk and different time frames. For example, my investment strategy as someone approaching the late 30s will be very different to someone in the early 20s who has just started out. My strategy is to invest in a few exchange-traded funds or ETFs, which are basically a basket of investments in hundreds, if not thousands, of publicly traded companies. For example, you can invest in ETFs which track the entire global stock market, consisting of thousands of companies. This diversifies my investments into various sectors and countries, which spreads out the risk and theoretically reduces my risk of making a loss. This is a very simple strategy, but when it comes to investing, being boring is simple usually wins out in the long run. I also invest a very small amount in more risky investments, but they make up a tiny percentage of my total portfolio. More on that later. My ETF investment strategy is split as follows: 50% into broad market, 25% into growth, and 25% into dividends. Broad markets tends to mean ETFs which track the global stock market or the US stock market. Depending on your source, the US stock market holds around 60% of the entire world market capitalization, and so investing in only the US tends to mean it's quite diversified. The US also contains the Magnificent Seven, the massive dominant tech companies such as Microsoft, Apple, and Amazon, which has grown to be very influential in the world of tech. I wanted to have a big portion of my investments into the broad market, which I deem as moderate risk. Note, my definition of moderate risk could be very different to your definition of moderate risk. This is because it would be the foundation of my investment portfolio, which has a good balance of having the right opportunity to grow well over the long term and pay out dividends, which I would reinvest. Next, I invest 25% into growth, which generally means the higher risk companies with huge growth potential. These days, it tends to mean the tech sector, and with the AI industry set to boom, I wanted to capture this growth potential. Of course, this means that it comes with higher risk because as fast as these companies can rise, they can fall just as fast. And finally, I invest my remaining 25% into dividend-paying companies, which generally tends to mean that they are well-established companies and tend to pay out dividends consistently. These tend to be industries such as the energy or banking sectors, to name two examples. They're generally deemed to be on the lower end of the risk scale because they are old, well-established companies which don't fluctuate in value as much compared to growth companies. But this means growth opportunity is limited compared to other sectors, but still decent, mind you. Once I decided which groups of companies I wanted to invest in, I then had to decide which ETF out of thousands available I should invest in. To do this, I used justetf.com, which is completely free and has a ton of information on ETFs available for UK investors. It takes a fair amount of research to find the right ETFs for you, but here are a few things to consider. The first thing to look into, and arguably the most important, is the total expense ratio, or TER. The TER expresses the ongoing annual costs of an ETF. These costs are automatically retained by the ETF provider and are already included in the price and performance of the ETF. You should therefore be trying to find the lowest TERs as possible. I generally don't even bother looking at any TERs which are higher than 0.5%, as it will erode too much of my investment value. 0.5% may not seem like a lot, but if you consider its impact over many decades of investing, it adds up and compounds the bigger your portfolio gets. The second thing to consider is what the distribution policy should be. ETFs are available in accumulating and distributing forms. Accumulating means that the ETF automatically reinvests the dividends that are received from the group companies it invests in so that it can benefit from compound interest. Generally, I like this method as I don't need to do anything when dividends are paid out, and I don't even see it. It's all done automatically. This compares to distributing types, which pays out the actual dividends to you, normally on a quarterly basis. You can do whatever you wish with these dividends, but be aware if you withdraw the dividends and go and spend it, you'll be severely hampering your long-term returns of your investments as you won't be benefiting from the compound interest effect. If you want to learn more about compound interest, I have a whole video of this, which I'll put up on screen and link to below. The third thing to consider, in my opinion, when it comes to determining which ETF to invest in, is what the replication is. The replication method describes how the ETF tracks the index. A physically replicating ETF tracks the index by buying the securities included in the index. This compares to other methods such as optimized sampling, where only the most important or liquid securities are purchased because these usually have the greatest influence on the index performance. I tend to prefer the physical replication as it will be exact copy of holdings in companies in the index, but it's personal preference. And the final thing to consider is the total fund size, meaning how much is invested in the ETF. You will generally want to choose the ETFs with a higher fund size, as this means more people trade this ETF regularly, making trading availability more liquid. So now that you know my investment strategy and how I research ETFs, let's get into exactly what I've invested in and why. As mentioned, I have 50% of my portfolio invested into the broad market to build the foundations of my portfolio. I have 42% of this invested specifically in the US S&P 500, or stock ticker VUAG. The S&P 500 is an index which tracks the performance of the 500 leading companies listed on stock exchanges in the US. The ETF will automatically adjust its weighting of each of the 500 companies depending on the market capitalization of each company, and will also adjust itself to remove companies that drop out of the index, replacing it with new entrants. The S&P 500 has historically returned 10% annually since its inception in 1957. Yes, we always say that past performance does not represent future performance, but when we look so far back in time, we can take some comfort at the time frame being so long. Note, this does not include the impact of inflation, so let's call it an annual return of 7% if we assume inflation averages out at 3% a year. So the reason why I chose VUAG as the main ETF of my portfolio is because it has an extremely low expense ratio of just 0.07%. It's an accumulation ETF, so the dividends are automatically reinvested, which means that I can benefit from compound interest with no effort at all. And this ETF follows the full replication method of how the ETF tracks the S&P 500. It's just my personal preference that I like to have ETFs which contain the actual investments in the stock of the index. And there are so many ETF options out there for tracking the S&P 500 index. So let me know in the comments below if you have any suggestions on ETFs available in the UK, which would be a good substitute for my recommendations. The remaining 8% of my portfolio that is invested in the broad market is invested in the All World Index. This is pretty much as it says in the tin. The index tracks all publicly listed companies globally. It's difficult to find a specific historical annual return of the all-world index, presumably due to the complexity, but it tends to be around the 9% region, so slightly less than the S&P 500. The reason for me wanting to diversify out of the US is simply to get some exposure to the rest of the world, as who knows what can happen in the future. The specific ETF I use is SSAC, which has an expense ratio of 0.2%. Like VOAG, dividends are accumulated and automatically reinvested, with the replication method being optimized sampling. Also, don't ask me why I chose to have specifically 8% invested in the all-world index. It's just what my brain came up with. As mentioned previously, 25% of my portfolio is invested in a growth ETF. For me, that takes form of an ETF that tracks the Nasdaq 100 index in the US. This index is weighted heavily towards the tech sector and has enjoyed growth of 14% annually since its inception in 1985. Whilst higher than the S&P 500, it is much riskier because the companies are weighted so much in the tech sector. If something disastrous were to happen in just the sector, it would really hamper the performance of this index. So for me, I want to get more exposure to tech, as I believe that AI is going to change the world as we know it, and tech stocks will be at the forefront of this. The ETF I use is XNAQ, which has an expense ratio of 0.2%, which has the lowest expense ratio that I could find for ETFs available for UK investors wanting to invest in the Nasdaq 100. This ETF accumulates its dividends with a full replication method. And the remaining 25% of my portfolio is invested in a dividends ETF. For me, I have an ETF that tracks the FTSE All-World High Dividend Yield Index, which has returned 7% since 2008. For me, it's not too important what the annual return for this index is, as the main reason I wanted to track this index is so that I limit the downside risk in the event of an economic shock, such as recessions. This index is generally deemed to be on the lower end of the risk scale because they are profitable, well-established companies and pay out regular dividends. Holding these investments aren't as low risk as holding government bonds, but I personally don't like the historical very low returns of the bond market. The ETF I use has ticker symbol VHYL and has an expense ratio of 0.29%, which is a bit high for my liking, but I'm yet to find another ETF that tracks the same index at a lower expense ratio. This ETF has a replication method, being optimized sampling. Unlike all my other ETF holdings, I wanted this one to distribute its dividends. This is because in the long-term future, if I ever get to retire, I would like to potentially use these dividends to supplement my income very slightly, but I will need to keep pumping in a large amount into this ETF to get a stage where the dividends pay out will be able to pay for my everyday expenses. For now, every time I receive a dividend from this ETF, I straight away manually reinvest it straight back into the ETF. So there you have it. I've summarized all of my ETF holdings here in this helpful table for reference. As a reminder, this video is not financial advice. Please do your own research. One caveat that I'm aware of in my ETF holdings is something called fund overlap. This is where the investments held in a particular ETF is also held in other ETFs in my portfolio. So for example, a big tech company like Microsoft will be in my ETF tracking the S&P 500, my ETF tracking the global stock market, as well as my ETF tracking the Nasdaq. This means that my exposure to these sorts of companies is actually higher, which reduces my diversification somewhat. However, I feel like I've already overanalyzed and overthought my ETF holdings, so I don't want to make it even more complicated. Professional investors always say that being boring and achieving the average return on a consistent basis for many decades is far better than trying to find the next big investment and risking your returns. Another thing I should mention is the frequency of investing. I like to do what is called dollar cost averaging, or DCA, which simply means investing the same amount of money every single month, regardless of the price of the ETF. This is generally proven to be a great way to invest into the stock market and massively reduce the risk of investing sporadically, which can mean you miss out on great returns. As they say, time in the market is best than timing the market. I dollar cost average as soon as I get paid for my job every single month, but some people prefer to DCA every week or even every day. In terms of riskier investments outside my ETF portfolio, I only have two, and they both make up less than 1% of my entire investment portfolio, so I'm not going to lose any sleep if their value plummets. Onto my riskier investments. The first riskier investment I have is a straight-up investment directly in NVIDIA, ticker NVDA. If you've been living under a rock, this company produces computer chips, including those used in AI applications. As I said before, I think the AI industry is going to boom in the coming decades, and I just really like this company. The second risky investment I have is in Bitcoin. There are a number of commentators that say that Bitcoin is going to explode in value. Some people are betting on Bitcoin going from roughly $100,000 now to $1.5 million by 2030, which is just insane. I'm personally quite skeptical that this will happen, but I wanted to have a small amount invested in Bitcoin just in case it did grow massively. So there you have it. You now have an idea of what a financial professional invests in. I hope it was insightful. Thank you so much for watching, and until next time, happy saving and investing. I'm Jeff, and I'll see you soon.